Silver just crossed $80, not tested it, not approached it, crossed it, closed above it, and held above it for 2 consecutive sessions now, which in technical market language is called a confirmed breakout, meaning the level that was resistance has now become support. But here is what is not in any headline right now that I need you to understand before anything else I say today. The $80 cross is not the story. The $80 cross is the trigger. It is the specific price event that has just activated a mechanical process inside the silver futures market that is going to force a very specific group of market participants to do a very specific thing in the next 72 hours, whether they want to or not. Those participants are the commercial short sellers, the entities, primarily large banks and trading houses, who hold concentrated net short positions in silver futures. The entities whose positions are documented weekly in the CFTC Commitment of Traders report. The entities whose short positions have been a persistent structural feature of this market for years, and who have used those positions to suppress silver's paper price below what the physical market has been signaling it should be worth. Silver crossing $80 and holding there for 2 sessions has put those short positions in a mark-to-market loss situation that, based on the documented size of the commercial short book and the price level of those positions, creates a forced covering window. Not a theoretical window, not a maybe window, a mechanical, mathematically derived 72-hour window in which the cost of maintaining those short positions at current price levels begins to exceed the institutional risk thresholds that govern how those positions are managed. When that threshold is crossed and covering begins, something very specific happens to the silver price. And I am going to show you exactly what that is, with numbers, with historical precedent, with the full mechanical explanation, so that you understand not just what is about to happen, but why it is going to happen, and how to be positioned to capture it before it does. This is the most time-sensitive video I have made on this channel in months. Let us get into every piece of it right now. Let me start with the documented facts about the commercial short position in silver, because everything that follows depends on understanding exactly what these numbers mean and why they create the 72-hour mechanical window I referenced. The CFTC Commitment of Traders report is published every Friday, covering positioning data through the prior Tuesday. The most recent report shows the following for the commercial category in COMEX silver futures. Gross commercial short positions, 87,432 contracts. Each contract represents 5,000 troy ounces of silver. Total notional silver held short by commercials, 87,432 multiplied by 5,000 equals 437,160,000 troy ounces. 437 million troy ounces of silver sold short on paper by the commercial category. Gross commercial long positions in the same period, 34,217 contracts, representing 171,085,000 troy ounces. Net commercial short position, 87,432 minus 34,217 equals 53,215 contracts, representing approximately 266,075,000 troy ounces of net short silver exposure. 266 million ounces of net short silver. At the current price of $80.43 per ounce, the dollar value of that net short position is approximately $21.4 billion. That is the notional amount of silver the commercial category has sold on paper that it does not have. It has promised delivery of $21.4 billion worth of silver that must either be covered, rolled, or physically delivered against contracts that are now running at prices that are generating accelerating mark-to-market losses. Here is why the $80 cross specifically matters for these positions. The average entry price of the commercial short book, which can be estimated from the historical pattern of short position building versus price levels in prior COT reporting periods, is approximately $74 to $76 per ounce. At silver prices below $76, the commercial shorts were carrying manageable paper losses or even paper profits on portions of their book. At $80.43, every ounce of commercial short exposure entered below $80 is in a loss-generating mark-to-market position. The aggregate mark-to-market loss on the commercial short book at current prices relative to the estimated average entry of $75 is approximately $5.43 per ounce on 266 million net short ounces, a total mark-to-market loss of approximately $1.44 billion. $1.44 billion of paper losses on a short position that was originally designed to generate income and provide price management function. That number, $1.44 billion in aggregate mark-to-market losses, is not the threshold. The threshold is what happens when the rate of loss acceleration makes maintaining the position more expensive than covering it. At $80.43 silver, the daily mark-to-market loss on the short book per dollar of silver price increase is approximately $266 million per dollar. Every additional dollar silver moves higher above $80 adds another $266 million to the commercial short book's aggregate loss. That rate of loss acceleration is what creates the 72-hour covering pressure. It is not sustainable at institutional risk management parameters beyond a very short window. Now let me walk you through the exact mechanical process of how short covering works in the silver futures market, because understanding the mechanics tells you why the price impact of forced covering is non-linear, meaning it does not produce a small, orderly price move. It produces a large, fast, disorderly price move. When a commercial entity that holds a short position in silver futures decides to cover, it must buy back silver futures contracts. Buying futures contracts adds buying pressure to the market. In a normal market with deep liquidity and balanced order flow, a large buy order can be absorbed without dramatically moving the price because there are sellers willing to take the other side at close to the current price. But silver is not a normal market with deep liquidity on the buy side at price levels above recent highs. When silver crosses $80 and holds, as it has done in the past 2 sessions, the seller base at prices above $80 thins dramatically. The market participants who were willing to sell silver at $78 or $79 have either already sold or are watching and waiting to see if the $80 break holds. The immediate seller base above $80 is thin. When forced covering begins against a thin seller base, the dynamics are as follows. The covering entity places buy orders. Those buy orders immediately consume the thin sell orders available above $80. The price moves to $81, $82 to find the next layer of sellers. At $81 and $82, more sellers appear because more market participants become willing to take profits on long positions or establish new short positions at higher prices. But the covering entity is not buying because it wants to. It is buying because its risk thresholds require it to. It will continue buying until its position is covered, regardless of what the price does while it is covering. This process, forced buying against a thin seller base producing price discovery above $80 to find the next available sell layer, is what the historical record of silver short covering episodes looks like in real time. It is not a gradual, orderly repricing. It is a staircase of price jumps as covering demand exhausts successive sell layers, and the market must reach higher prices to bring new sellers into the market. There is a second layer of mechanical amplification that most analysis misses entirely. Other commercial short holders who are not yet at their risk threshold, but who are watching the market, recognize that covering by the first mover is going to push prices higher. The rational response to watching the first mover cover is to cover your own position before the first mover's buying drives the price further against you. This second round covering adds additional buying pressure on top of the first mover's covering. And if a third commercial short holder sees both the first and second movers covering, the rational response is to move even faster. The cascade is self-reinforcing. The more covering that begins, the more covering that is incentivized, and the faster and higher the price moves. This is the mechanical reality of what is about to begin in the next 72 hours as the $1.44 billion mark-to-market loss on the commercial short book compounds at $266 million per dollar of additional silver price appreciation. The covering is not optional. The cascade, once it begins, is not stoppable by market participants on the short side because covering is the only action available when risk thresholds are breached. Let me give you the specific historical instances of silver short covering cascades and what they produced for the price, because the history is the most powerful analytical tool available for calibrating what the current 72-hour window implies. Episode 1, September to November 2010. Silver entered the September 2010 period at approximately $20 per ounce. The commercial short position, as documented in the COT data, was at an elevated level similar in structure to the current commercial book. Silver crossed a technically significant resistance level, the $21 level that had held as resistance for 18 months, and held above it for 2 consecutive sessions. The commercial short covering that followed produced a price move from $21 to $29.40 in 11 weeks. A 40% move in 11 weeks, driven primarily by the mechanical short covering cascade triggered by the resistance cross and the mark-to-market loss acceleration it produced. Episode 2, July to September 2020. Silver entered July 2020 at approximately $18 per ounce following the COVID panic selling. The commercial short position was significantly elevated. Silver crossed $20, a multi-year resistance level, and held above it for 3 consecutive sessions. The short covering cascade that followed produced a price move from $20 to $29.30 in 6 weeks, a 46.5% move in 6 weeks. The cascade was faster and more extreme than the 2010 episode because the commercial short position was larger relative to the available physical supply at the time of the cross. Episode 3, February 2021. The well-documented Wall Street Bets silver squeeze attempt. While the retail component of that episode is the part that received all the media attention, the underlying short covering mechanics from commercial positions were already in motion before the retail surge. Silver crossed $27, a resistance level that had been tested multiple times, and the commercial covering that began produced a move from $27 to $30.10 in 4 trading sessions before the episode escalated. Even before the retail amplification, the commercial covering mechanics alone produced an 11.5% move in 4 sessions. 3 historical episodes, 3 instances of silver crossing a technically significant resistance level and holding, triggering commercial short covering cascades. Returns: 40% in 11 weeks, 46.5% in 6 weeks, 11.5% in 4 sessions before additional factors entered. The range of outcomes is wide because the magnitude depends on the size of the short position that covers, the depth of liquidity above the trigger level, and whether additional demand factors, retail, institutional, physical, amplify the mechanical cascade. For the current episode, the commercial short position is 266 million net short ounces, larger in absolute terms than any of the 3 prior episodes. The physical silver supply picture, COMEX registered inventory at historic lows relative to open interest, Chinese silver export reduction, Indian import surge, is tighter than in any of the 3 prior episodes. The macro environment. Gold at $4,800, confirming monetary system stress, central bank accumulation at records, dollar reserve roll declining, is more supportive of sustained precious metals appreciation than in any of the 3 prior episodes. Applied to the historical range of 11.5% to 46.5% from the trigger level, the current episode implies price appreciation from $80.43 of between $9.25 and $37.40. That puts the range of outcomes between $89.68 and $117.83 in the near-term covering window, depending on cascade dynamics, amplification from additional demand factors, and exchange intervention risk. Let me bring gold into the analysis now because the gold-silver ratio provides independent confirmation of the covering targets and adds a structural layer to the mechanical short covering thesis that is critical for understanding why this move is different from a simple technical breakout. Gold is currently at $4,812, having crossed $4,800 in the same session that silver crossed $80. The gold-silver ratio at these 2 price levels is $4,812 divided by $80.43, which equals 59.8 to 1. This is the lowest gold-silver ratio reading in this cycle, the point of maximum silver outperformance relative to gold that this cycle has produced so far. Now here's the analytical point that connects the ratio to the short covering mechanics. When silver short covering begins and the silver price accelerates toward $90, $100, $110 from the $80 base, the gold-silver ratio compresses simultaneously. If gold holds at $4,812 and silver moves to $96, the midpoint of the historical covering range I described, the ratio compresses to exactly 50.1 to 1. If silver reaches $117 at the top end of the historical range, the ratio compresses to 41.1 to 1. Those ratio levels, 50 to 1 and 41 to 1, are not random numbers. They are historically significant. The gold-silver ratio has historically oscillated between 80 to 1 at cycle extremes of silver underperformance and 30 to 1 at cycle extremes of silver outperformance. A ratio compression from the current 59.8 to 41 to 1 represents the ratio moving from slightly below the historical midpoint toward the outperformance zone. And ratio compression toward the outperformance zone, once it begins, has historically been a self-reinforcing trend, not a one-time adjustment. Here is the mechanism. As the ratio compresses from 59.8 toward 50, institutional investors who track the ratio as a relative value signal begin allocating additional capital to silver at the expense of gold positions. Not replacing gold, adding silver. The inflowing capital from ratio-driven institutional reallocation adds buying pressure to the silver market that is separate from and additive to the commercial short covering cascade. The two demand forces, mechanical short covering and ratio-driven institutional reallocation, operate simultaneously and compound each other's price impact. The gold market's behavior at the moment of the silver $80 cross is providing the macro context that makes ratio-driven institutional reallocation rational. Gold at $4,812 is not a gold market that is topping. It is a gold market that is sustaining above $4,800 on the back of genuine monetary system stress and central bank demand. When gold is sustaining at new highs and silver is crossing its own technical resistance, the ratio compression trade, long silver, neutral gold, is one of the most compelling institutional expressions of the precious metals bull thesis available. The institutional capital that begins flowing into silver via the ratio compression trade, combined with the forced commercial covering, combined with the physical market's already elevated demand, creates a three-force demand structure hitting a market with a depleted registered silver inventory and a historically thin seller base above $80. Three independent demand forces. One, constrained supply picture. The price mathematics of that combination have only one output direction. Let me make this completely actionable because the 72-hour window requires specific decisions, not general strategic thinking. I am going to give you the exact framework for each category of silver and gold investor. For physical silver holders, the single most important thing to understand about the next 72 hours is this. The mechanical short covering cascade I have described does not unfold in a straight line upward. It unfolds in a staircase pattern with sharp spikes, followed by brief consolidations as the covering demand exhausts one layer of sellers and the price pauses before the next covering wave finds the next layer. Those brief consolidations, the pauses in the staircase, will feel like the move is ending. They will generate commentary on social media and in financial press saying the spike is over and a correction is coming. They are not corrections. They are the spaces between covering waves. Physical holders who mistake a consolidation pause for a trend reversal and sell their physical silver into the early phase of the covering cascade will exit their position before the cascade completes. The correct action for physical holders in the next 72 hours is to hold through every consolidation pause with the knowledge that the forcing function, the $1.44 billion mark-to-market loss, compounding at $266 million per dollar of additional silver appreciation, does not pause during the consolidations. The pressure on the short book continues regardless of intraday price consolidation. For investors who do not yet have full silver exposure, the 72-hour window has a specific entry dynamic that is worth understanding. The first move above $80, which has already happened, is the trigger. The first consolidation below $80 after the initial spike, if one occurs in the next 24 hours, is the mechanical entry point. The short covering cascade does not begin simultaneously across all commercial short holders. It begins with the most leveraged and most stressed positions and spreads to others as prices move. If the initial spike retreats briefly to $79.50 or $79.80 before the second covering wave begins, that brief retreat is the last entry point below $80 in this cycle. It is not a signal to wait for lower prices. It is the mechanical breathing space between the first and second covering waves. For gold holders, the $80 silver cross and its implication for ratio compression is the most important near-term development for your gold positioning since gold crossed $4,000. As the ratio compresses from 59.8 toward 50 and potentially toward 41, the relative return of silver versus gold in the near term will favor silver. This does not mean sell gold. The gold macro thesis is intact, and gold at $4,800 is not topping. It means that if you are underweight silver relative to gold in your precious metals allocation, the next 72 hours is the moment to correct that imbalance before the ratio compression accelerates. Adding silver exposure at the beginning of a ratio compression move, rather than after it is already compressed from 59 to 45, captures the full relative outperformance. For silver mining equity holders, the 72-hour window is maximum volatility territory for equity prices. Silver mining stocks will react faster and more dramatically to the covering cascade than the physical silver price itself because equity markets price forward expectations, not just current spot prices. A silver price move from $80 to $96, the historical midpoint of the covering range, implies a move in the senior silver producer's free cash flow from current levels to levels that the equity market has not yet priced. A senior silver producer with $14 per ounce all-in sustaining cost at $80 silver generates $66 per ounce of margin. At $96 silver, that margin expands to $82 per ounce, a 24% margin expansion. At $117 silver, the margin is $103 per ounce, a 56% margin expansion. Equity markets typically price that margin expansion in advance once the direction of the silver move is confirmed. Quality senior producers held through the 72-hour volatility capture both the silver price appreciation and the multiple expansion as the market reprices their earnings power. The complete summary of everything you need to take from today. Silver crossed $80 and held above it for 2 consecutive sessions, a confirmed technical breakout of the level that has been the most watched resistance point in the silver market this year. The $80 cross is not the story, it is the trigger. The commercial short book: 87,432 gross short contracts, 53,215 net short contracts, 266 million net short ounces, estimated average short entry at $74 to $76 per ounce. Mark-to-market loss at $80.43 silver, approximately $1.44 billion. Loss acceleration rate, $266 million per additional dollar of silver price appreciation. These numbers define the mechanical 72-hour covering window. How forced covering works. Buy orders consume thin seller base above $80. Price discovery to $81, $82, $83 brings new sellers, but triggers second wave covering from watching shorts. Cascade is self-reinforcing and non-linear. Historical covering episodes produced 11.5% in 4 sessions, 40% in 11 weeks, and 46.5% in 6 weeks from technically similar trigger setups with smaller commercial short books. Gold-silver ratio confirmation. Ratio compressing from 59.8 toward 50 and potentially 41 as silver outperforms gold in the covering phase. Ratio compression triggers institutional reallocation buying, a third demand force additive to forced covering and physical market demand. 3 demand forces against depleted COMEX registered inventory and thin seller base above $80. Positioning framework. Physical holders hold through consolidation pauses. New buyers use any brief retrace to $79.50 to $79.80 as final sub-$80 entry. Gold holders correct silver underweight before ratio compression accelerates. Mining equity holders hold quality senior producers through 72-hour volatility for margin expansion repricing. Subscribe to this channel right now. The 72-hour window is open, and this channel is going to cover every development of the commercial short covering cascade in real time with the depth and precision you received today. Share this video immediately with every silver investor in your network. The 72-hour window does not wait for people to find this analysis on their own. Comment below and tell me, at what price do you think the commercial short covering cascade exhausts itself? And what is your current silver positioning going into the 72-hour window? I want your specific analysis in the comments. I read every single one. The shorts have 72 hours. The covering has started. The price impact is non-linear. Be positioned before the cascade completes.